Okay, in this video, we wanted to explain the difference between options and stocks and whether or not you can just buy stocks if you're thinking about buying options, and what is the difference between the two and the major disadvantages and advantages between the two. And what we'd like to use Apple as the example. This is the Thinkorswim platform on TD Ameritrade. And so we'll start right away to kind of explain it with using stocks first. So let's say we buy 100 shares of Apple, okay? And so you'll see that one of the major advantages of this trade is that when we look at the Greeks, the theta is 0, which means there is no time decay on this. So you can hold on to this stock at this for indefinitely, and there's nothing that is going to decay your stocks unless the price just drops on its own, as it drops here. This is the price on the x-axis. Currently Apple is at 163. This is the profit loss diagram. Above the 0 line on the y-axis is a profit, and this is a loss, so anything below that. So with this theta decay, this is very relevant, because if you buy options, that's when things are going to be different. So for example, if we were to get an option that is 16 days away on April 21, today's April 5, let's say we get the 165 call options and we analyze this, you'll see here that there is a theta decay here now. It's a -10, right? So as time goes on, you're actually going to be losing money if the price stays where it is. Okay, so you'll see here as you move this time closer to expiration, this starts to get closer to the blue line, which is the maximum loss on this option, which is the price you paid for it, 261. Okay, and so this time decay works against you. Not all options will have a decay, because you can actually sell an option and it's actually going to be a positive decay. But selling options gets a little bit more complicated, so we won't explain that right now in this video. But these are the major differences, is that there are these Greeks that affect the options value that you have to take into account, that you don't have to worry about when you buy stocks. And there are advantages to this, because, for example, if you wanted leverage and you think Apple stock is going to increase, well, you can get the same amount of leverage as somebody else who paid 100 shares of Apple. Let's say they paid 100 shares. They would actually have to pay this amount 16,365, because one share is 163. So for them to for every price, for every 1 point increase in Apple, let's say Apple goes to 164, it's at 163, they would gain $100, because they have 100 shares. So that's why the delta is at 100. But if you had the options now, you can actually, if you had just 3 of these, you have a delta now of 136. So that actually makes you more profitable than the person with 100 shares of stock. And you didn't have to buy or spend 16,000. You would have only had to buy 3 option contracts. So that's 261 times 3, which is 783. So just spending 783, you could get the same amount of, well, more, because it's 136. That's more than 100, which is what you get when you get the regular stocks. And so that's the advantage of having using call options instead. and but then keep in mind you have that negative theta decay. If the options, the stock price is not moving, it will be decaying against your profit loss situation now. So keep that in mind, that whenever you buy an option, there is a break-even point that you have to break in order to gain as time goes on. So that's something that you have to take into account when you buy options because of this theta decay. Okay. So yeah, so that's a quick video on just the explanation on stocks and options. And if you found this video helpful, give us a thumbs up and like, and subscribe if you haven't, if you wanted to learn more strategies with options trading. All right, take care everybody, and good luck on the markets.